Welcome back to the channel. There's a REIT that looks like the safest thing on paper. UK government rent, essential public services, and properties that support Jobcentre Plus sites, the kind of tenant profile that should let income investors sleep well at night. But for the past year or two, it wasn't, because the real risk was never whether the government would pay. The real risk was the lease structure. Almost everything was expiring at the same time, creating a cliff that the market couldn't ignore. And when a REIT has a cliff like that, investors don't price it like a defensive income play anymore. They price it like an event. Now here's what's interesting. That cliff has just been materially diffused, quietly, and the market reaction has been surprisingly muted. So today, I want to break down what changed, what it cost, what risk still remains, and whether the valuation is still stuck in the old narrative. But before we plunge right in, let me remind you that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. I own some of the REITs discussed, but what works for me might not work for you. Alright, let's get started. A government landlord with a very specific niche. The REIT I'm talking about is Elite UK REIT. Before we talk about the old thesis and why the market was so nervous, let's reset the basics for anyone less familiar with Elite UK REIT. Elite owns a portfolio of UK properties that are primarily leased to the UK government. The largest tenant is the Department for Work and Pensions, or DWP, which runs Jobcentre Plus sites, public-facing locations where people access employment support and benefit services. So in theory, this REIT is supposed to be boring in the best way. What's also changed in the past year is that Elite is no longer just a passive government landlord. It has started to look more like a landlord with a deliberate value creation toolkit. A small number of assets are being repositioned or converted, and one of them, Peel Park in Blackpool, has now secured planning consent for a proposed data center development. That doesn't change the REIT's core identity, but it adds a second lever that can matter for valuation once the lease story is stabilized. It's not a trophy office landlord betting on City of London demand. It's not a retail landlord hoping discretionary spending rebounds. It's closer to a social infrastructure landlord. The government needs physical locations to deliver essential services, and those services don't vanish just because GDP is weak. That's why Elite originally appealed to income investors. Government tenants are usually viewed as high quality. Collection risk tends to be low. Occupancy can be stable. And when leases are long, the cash flow profile can look almost bond-like. But here's the twist. In REIT investing, tenant quality is only half the story. Lease structure is the other half. Even a strong tenant can become a valuation problem if your leases are arranged in a way that creates one massive maturity cliff. And that was Elite's issue. The old thesis: one great tenant, one very big problem. For a long time, the market's main fear was not will DWP pay rent. The fear was will DWP still be here on acceptable terms when the leases end. Elite's maturity profile had a nasty tower. The REIT highlighted that 95.7% of gross rental income was concentrated in FY 2028 expiries. In plain English, almost the entire portfolio was coming back to the negotiating table at roughly the same time. That creates a single point of failure. If renewals go well, the REIT survives and possibly re-rates. If renewals go badly, distributions and valuation could take a meaningful hit. And because the whole thing was so concentrated, investors couldn't diversify the risk away inside the REIT. The risk was embedded in the structure. So Elite ended up valued like a REIT waiting for a major verdict. One extra layer to understand the fear back then is that government, despite being a strong payer, can still be a tough negotiator. Governments consolidate. They standardize. They tender. They also adapt how services are delivered. If more services move online, or if workflows change, the government may still decide it needs fewer sites, or different sites, even if the mission of serving citizens remains. That's why the market never treated Elite's tenant quality as a free pass. The tenant was strong, but the renewal event still carried bargaining risk. And the big question was always, can they remove the cliff? The thesis change. The 2028 cliff was diffused. Elite has now executed a lease re-gear with the UK government that materially changes the risk profile. Before the re-gear, Elite's WALE by gross rental income was about 2.4 years. On a pro forma basis after the re-gear, it improves to about 7.2 years. More importantly, The 2028 expiry exposure has been lowered from 95.7% to 32.0% of gross rental income. That is not a small improvement. A REIT can manage a 30% maturity event. It may still be a key risk, but it's a manageable tail. A REIT with a 95% maturity event in a single year is basically a hostage situation. Elite also highlights something subtle but important. The new lease agreements have zero lease breaks, and earlier lease breaks were removed in 2023. This matters because lease length is only real if the tenant can't simply walk away earlier. So from a risk management standpoint, Elite has gone from one-year cliff to more normal ladder. One important detail: these new lease agreements are structured to commence in 2028, immediately after the existing leases expire, so the main benefit today is future income visibility rather than an immediate jump in rent. We shouldn't stop at the Wall chart. The next step is to understand what Elite signed, because that determines the quality of the improvement. What Elite actually signed: lease lengths, options, and CPI linkage. The re-gear is not just extend everything and call it a day. Elite's materials provide the shape of the deal. Elite states that DWP-occupied assets with £24.3 million of annual rent have been re-geared ahead of the 2028 expiries, with the majority being re-geared to around 7 to 10 years. The examples show maturity dates stretching into 2029, 2031, 2035 and even 2038, with option lease terms after expiry of 3 to 5 years depending on the asset. To me, that's meaningful. It suggests the government is not just buying a short extension. It is committing to a more durable presence across a substantial tranche of the portfolio, with built-in options that can extend occupancy further. Now the key economic detail. Elite highlights CPI-linked rent review mechanics based on annually compounded CPI, with a minimum of 1% and a maximum of 5%. This is the part that helps viewers understand why the new Elite is less fragile, but not necessarily a high-growth story. CPI linkage gives you a rules-based inflation hedge. The minimum protects the landlord in low inflation. The cap protects the tenant in high inflation. It's a compromise, and it makes sense for government leases. But it also means you should be careful about assuming big rental reversions like you might see in a prime Singapore mall. This is designed to be predictable, not explosive. And then there's timing. CPI linkage matters only when reviews actually take effect. Depending on the rent review schedule, growth could be gradual rather than immediate. So the main win here is not sudden income growth. The main win is visibility. But no deal is free, and Elite makes that very clear. The price of de-risking, the £9.5 million capital incentive. Elite states it will contribute a one-time capital incentive of £9.5 million over 2026 to 2028 to DWP-led asset enhancement initiatives. This is important, because it tells you the re-gear wasn't achieved with pure negotiation magic. There is a tangible economic concession, and whether you love or hate the deal depends on what you believe this spending achieves. The optimistic view is that this is targeted enhancement spend that keeps the sites fit for purpose, supports long-term retention, and reduces the probability of vacancy or disruptive relocation. The cautious view is that even productive CapEx still needs funding. If it's funded via debt, it can pressure leverage and interest cost. If it's funded via operating cash flow, it can constrain distributions during those years. So the correct investor stance is, acknowledge the huge de-risking win, but track the cash flow consequences through 2026 to 2028. Now, even after this big tranche, there's one remaining chapter. What still isn't fully resolved: the remaining 32% in 2028. Elite has reduced the 2028 expiry exposure to 32.0% of gross rental income. That is a big improvement, but it is not zero. Management also states that negotiations on the remaining assets will continue. So the thesis has moved from a massive cliff to a remaining tail. This is where the market's slower reaction can make sense. Investors often don't fully re-rate a situation until uncertainty is mostly removed. One big tranche is great, but the market will still ask, what happens to the remaining tranche, and will the economics look similar, or will the concessions be heavier? So if you feel analysts and investors haven't fully reacted, it could simply be because the market is waiting for closure. Not because the first tranche isn't significant, but because the last tranche will decide whether the old overhang narrative truly dies. That's why the balance sheet and runway matter. Time is negotiating power. The balance sheet. Runway helps you negotiate from strength. Elite's FY 2025 materials highlight that there are no refinancing requirements until 2027, with extension options providing additional runway. They also show key metrics that matter for resilience: net gearing at 40.7%, NAV per unit at 40 pence, borrowing costs at 4.7%, 85% of interest rates fixed, and an interest coverage ratio around 2.6 times. These aren't perfect numbers, but they do suggest Elite isn't negotiating renewals from a position of desperation. And that matters, because renewal outcomes are not just about tenant quality. They are about how much leverage each side has at the negotiating table. At the same time, we should keep our eyes open. UK rates and UK property sentiment still matter, because they influence both refinancing terms and valuations. A defensive tenant reduces one risk, but it doesn't remove macro entirely. Now let's connect this to what most investors actually care about: distributions. But before we move on, I want to take a short pause to ask you to subscribe to the channel and give the video a like to support my research. And if you want to treat this uncle to a coffee, or even a lunch, join me as a channel member. Alright, let's get back to the video. Distribution reality: better visibility, but watch the incentive period. In FY 2025, Elite reported DPU of 3.03 pence, up 5.6% year-on-year, with distributable income up 4.6%. Management attributes part of this to capital management and interest optimization. That's the encouraging part. Elite has been actively managing financing, not just waiting for luck. However, the £9.5 million incentive over 2026 to 2028 means we should watch how distributions behave through that period. Even if the spending is productive, it still needs to be funded and phased. The best case scenario is a smooth, manageable impact that strengthens the tenant relationship. The worst case scenario is that it becomes a drag that investors didn't fully appreciate. Valuation: is Elite still priced like a problem REIT? Elite's reported NAV per unit is 40 pence. When a REIT trades at a discount to NAV, investors usually ask whether the discount is justified by structural risk. For Elite, the old justification was clear. The lease expiry cliff created massive uncertainty. If income beyond 2028 is questionable, then NAV is questionable. Now that the cliff has been materially diffused, the market's discounting logic weakens, but it doesn't vanish overnight. And this is where the development catalyst becomes relevant. If the market continues to price Elite purely as a lease renewal story, then it may be missing a second source of potential re-rating: assets where planning progress can translate into value crystallization. Peel Park is the standout example, because Elite has now secured planning consent for a proposed data center on a large freehold site, and management itself points to a meaningful valuation uplift to £40 million, as at end 2025, driven by repositioning progress. The market won't give full credit until monetization is clearer, but consent materially reduces planning risk, and that can matter for how investors eventually view NAV quality and upside. My view is that the not priced-in upside is not about one magical re-rating day. It's about a staged repricing path. First, the market needs to accept that Elite is no longer a 95% in one-year cliff situation. The Wale improvement and reduced 2028 exposure help, but perception often lags reality. Second, investors want progress or closure on the remaining 32% tranche. Even if terms are not as favorable, clarity reduces uncertainty, and uncertainty is what drives harsh discounts. Third, investors will watch how distributable income behaves through 2026 to 2028 as the incentive spend is deployed. If those three pieces progress reasonably, a discount to NAV situation can narrow, not because Elite becomes exciting, but because it becomes less fragile. And in REIT investing, less fragile is often the real catalyst. And one last small thing that's worth mentioning. In March, Elite introduced dual currency trading with an SGD counter, and it also returned to the FTSE Global Microcap, Total Cap indices. So I wouldn't call these fundamentals, but if the lease risk is genuinely being diffused and the development catalysts are gaining traction, these small access and visibility improvements can help the market reprice the REIT more efficiently. The Dividend Uncle's Take, a real thesis shift, with one more chapter to close. Here's where I stand. I do think this renewal package changes the investment thesis in a meaningful way. Moving the 2028 exposure from 95.7% down to 32.0% is a structural de-risking, not a cosmetic adjustment. And while moving from 2.4 years to 7.2 years changes how we should think about cash flow visibility. But I also understand why investors are still cautious. Because 32% is still meaningful. Because the £9.5 million incentive is real. And because UK macro risk and tenant concentration don't disappear. So if you're looking at a REIT today, the right mindset is not problem solved, re-rate now. The right mindset is problem massively reduced. But we still need closure on the tail, and we need to watch the economics. That's the kind of setup that can create opportunity, especially when the market is still stuck in an old narrative. If you found this breakdown useful, help me out with a like, it really supports the channel. Subscribe if you want more REIT deep dives like this, and let me know in the comments, do you think the market is underreacting to a REIT's lease re-gear, or is it right to stay cautious until the remaining tranche is done?